Hi guys, and welcome back to my channel. So today we're going to talk about how to evaluate growth stocks and how to find those, the next opportunity to really invest into something that could turn your initial investment to, 10x, 100x, and so on. And we're going to use the example of Teladoc, which is one of my positions that I've recently been holding and been building up, and we're going to go through sort of what my thought process is when I analyze those new opportunities and what I sort of look at before I invest. So let's get right into it. So I've just opened up the first sort of initial page here on Yahoo Finance, where you just look up the ticker for Teladoc Health, which is TDOC, and you really just have a first look at it. What's the price currently? What has it been trading at? You can see that for the past 6 months, or actually, for a matter of fact, for the past year, it's been trending down. So sort of based on just the graph, it kind of feels like, okay, there must have been something happening in the background that makes this type of stock going down. It's either company specific or, in terms of the macro environment. So this sort of looks like an interesting chart for me, because I don't want to see a stock going up and up and up and then keep buying up the top and the peak and the next peak. I want to keep buying a stock that has been beaten down and where the sentiment is very negative, because I think that's where most of the opportunity is. If it's actually a good company, it's just been beaten down and eventually will bounce back. So this is sort of what I first look at. Of course, if you look into any new companies, you want to find out what is this company actually about. So my first sort of address for that is the investors relations page. So I've just kind of gone through that investors relations page of Teladoc Health, and you really want to get to know the company and what they're actually doing. So Teladoc Health, for anyone that doesn't know, they're really connecting you to your doctor via virtual healthcare. So basically, you calling your doctor on your mobile device or your laptop or your PC, and rather than going to the actual practice and talking to him in person, you do your appointments online without any sort of contact, fully digital, which definitely during the sort of COVID crisis recently that happened, this type of investment idea, the remote type of remote work, remote health, that really has been something that's interested a lot of investors. So Teladoc has seen a rise of interest, significantly over the past few months and years, for a matter of fact, which has been trending down as we saw recently. So, but this is basically the fact why this has come to my attention. So I would look into what does the company actually do. Who's the management team, which is very important always. So you want to find out who are these people by reading about them. But I think the best way to actually do it is listening to conference calls, which is all on the investors relations page here as well. So if you click into the actual resources, financial info, stock info, you will get to the conference calls where they actually talk about their performance over the quarter or the year, and where they see the companies going in the foreseeable future. And I think this is a very good thing to actually listen to them, get to know the management, and just by really just listening to them and sitting back and having them talk to you, you get a really good impression of who these people are, what their character is, are they sort of competent in your opinion. And I think it's really important to listen to the conference calls and not just read articles about it. So this is sort of the management aspect and what the company does. Those are the kind of key things that I first look at. After I'm happy with the company's vision, and this kind of aligns with my investment strategy and my vision, where I think companies or that particular industry is going, then I would actually look into the financials of the company. So in the case of Teladoc, so I will go back to Yahoo Finance, and then actually look at some of the key aspects. So we see that the market cap, which is the total value of the company, sort of all the shares outstanding times the current price per share. So that is currently sitting around a 14 billion market cap, which is not little, but it also means that if they keep executing, there's definitely room to grow to, this could easily be a 40, 50, 60 to 100 billion market cap in the future if they keep executing. So there's definitely room to expand, given that healthcare and healthcare services is such a huge market. It's a $1 trillion industry. So if Teladoc, as we said, keeps executing, and if they gain more market share of that, then they will definitely have time to grow their market cap as well. The next one is actually going a bit deeper into the statistics. So there's a key, but depending on which stock it is, and this is particularly a growth stock which does not make any real profits right now, so they're running at a loss. So for that type of stock, we really want to look at sort of revenue multiples at the moment. So the price to sales ratio is important here. Anything that's under 10, we could say that it's sort of reasonable. It's not over the top. This has been trading for well over 10 in the hype season of February 2020, when sort of all the growth stocks and Cathy Wood type stocks went through the roof and just up 5% basically every day. This has since been trending down, so now that it's reaching a 7.5, like below that 10 price to sales ratio, it starts to become interesting. Obviously we don't have the other, historical traditional metrics like the PE ratios and the PEG ratios. So at the moment, from a price to sales ratio, we can be happy with that. What I do next then after sort of just looked at the high level ratios, is just really having a look at the income statement first. So what I want to see is consistent exponential revenue growth, which definitely for Teladoc has been the fact over the past years. We can definitely see that from 2019 to 2020, right in that COVID spot, revenue basically doubled. And since then, it's still been growing significantly, although that growth is expected to, tick down a little bit because of, obviously COVID is easing up, the restrictions are easing up, more people are actually going to their doctors like they used to. We still see that rise in revenue as they've made a lot of contracts with businesses and keep growing exponentially at this stage still. Although it's not an 80% plus rate, we're still looking at an over 20% revenue growth rate. So from a revenue growth perspective, I'm happy with that. Looking at the gross margin, so if you were actually to calculate this, so basically dividing gross profit by the total revenue, you would see that it slightly ticks up year by year, which is also what we want to see. Started off with an already great 65% for 2018 to now around 67% gross margin, which is a very significant margin, very, very nicely. We definitely see that there is, selling expenses, which probably be a lot of marketing and also R&D expenses, which you kind of expect for this type of company because they still have to grow. They still have to build that brand across the whole market. So all of their profits basically reinvesting into marketing and selling expenses to keep selling the product, to keep growing in the near future. So this is what particularly this stock leads to a loss of around 810 million. But it doesn't really concern me too much, as I can see that the gross margin is really strong. So that means that if they reach a level where they have expanded in their market properly, they will actually lower those marketing expenses, which means that eventually there will be a nice profit coming down from a almost 70% gross margin. You can probably expect around a 30 to 40% margin, net margin at the net income level. So this is from an income statement perspective. Then moving on to the balance sheet, what I would look at here is, from a high level, does their actually current assets cover their current liabilities, which we can see for Teladoc they're well above. So they have like $1 billion in cash equivalents or current assets, and they've only got 300 million in current liabilities, so they're well covered like within the next 12 months for any sort of bankruptcy risks. But even looking at the long-term debt, which is 1.4 billion, but as I said, they already have 1 billion in cash, so they're almost able to pay that entire loan off, which means that although it seems high at 1.4 billion, compared to their cash balance and their current assets, it's not that high at all. Like if you net that off, we've got it up around a 400 million debt, which is quite manageable for a company of that size, given that revenue is already at around 2 billion now, and expected to grow even further in the next few quarters. So this would be sort of a high level analysis, and then after I've checked those, balance sheet, income statement, and management, and get to know more about the company, the next step is going back to the investors relations, going to financial info, and then really digging deeper into the actual numbers. So if you filter here for annual or quarterly reports, so at the moment the newest one is the quarterly report from November 1st 21. You basically just download that, and then you really have to, it's a bit overwhelming. I really like, it's like around 100 pages usually. This time here it's only 40, so it's quite manageable. But yeah, you basically have to go into the details of all the numbers. But also what I find interesting is when you scroll down a little bit, they will actually tell you about the key risks that they identify for their business. So if you just look up the risk factors here, they actually talk about they're obliged to actually disclose all their risk factors, so that you will always be able to see what their potential risks are for that particular business, which is really it's really interesting and really important also to understand that, obviously. And then what you would do is, once you're happy with all of that, so you've gone through the report, you've done your homework on who the management is, you've listened to conference calls, then you would actually go into a little bit of a sort of technical analysis. I mean, you don't have to be an expert, but what you want to see is, especially right now, it's kind of like trending down all the time, and it's not because there's any particular company news or something. It's really just the macroeconomic environment that we are in, and that interest rate hikes and heightened inflation are threatening growth-related stocks just because of the valuation model. That it's actually good keyword, because I actually also prepared a little valuation model. So you've read all these kind of inputs and all these metrics, right? And obviously on Yahoo Finance you can already see that there's already over 20 analysts covering the stock, and they're all doing their DCF models and their valuation models, and they all come up with a range of what the stock should be trading in. But it's always good for your understanding, to just do your own little DCF model. And it might look complicated here, but it's actually not that complicated at all once you know what to put in. So you can download this type of form anywhere in the internet. Just type in DCF model Excel. You get a blank field of that, and all the information that's here and sort of here in that range is all given in the financial statements or in Yahoo Finance. So what I've done, I've just put in a high level calculation here, and then you have to make assumptions of where's revenue growth going, and based on the margins that you can see right now, project a net income margin, which would be your EBIT, so your your earnings before interest and tax. So you have to really make an educated guess based on the margins you can see in this type of industry and for this company. So I've really done a quick calculation here, and we, based on that, I can already see that intrinsic value is significantly above the value that the stock is currently trading at, because it's just the macroeconomic environment that we are in, that these types of stocks are really getting hammered, and any type of future growth is not really of interest right now for the investors. So they really look at what are companies that are making cash right now. So those companies that are making a loss right now, they're not really interesting for investors at the moment. So yeah, it's good to do your own little calculation to just double check and understand actually what are the metrics and at what price. So let's say you're buying at that 86 level, just to understand high level of what type of upside are you looking at. Are you happy with that upside? So if you see, okay, there's an upside of almost 100%, which if you break it down into, you expect that within the next 1 or 2 years, that would obviously be a fantastic return. So you'd be happy with that, and you would be happy to invest at the $86 price level. But let's say if you do your calculation here and you understand that your return only gonna be 15% over the next 2 to 3 years, then you're obviously gonna be like, okay, I might as well just invest into something else, or an index fund which probably gonna return a similar level of percentages to me. Yeah. But for this type of investment here, we obviously see that if the growth keeps being as anticipated, which I've basically said, revenue growth is going to be 25%, and the net income margin for this particular revenue growth 30% and net income margin 40%. So on the bottom line, so that 70% gross margin, it ends up being 40% at net income level, which is kind of a reasonable assumption based on that super high margin of this business. Once you put that in, you actually understand, okay, what is my upside here? What if I buy this at the 86? What does that actually mean as my potential upside compared to if next week it goes to 75, which obviously would make it better, or next week it goes to 110, which obviously would make it worse. So you have to understand. So when I said, okay, do a little bit of a technical analysis in terms of when you buy in, this is just to understand at what price level are you buying, and what does that price level return to you on an annualized basis. And if that aligns with your investment goal, so let's say you want to grow your portfolio by 20% each year, and your annualized projected return for this investment is 30 to 40%, then obviously it meets your investment criteria, and you can happily invest at 86. And you don't have to wait for this to go even lower. Although it could potentially go lower next week, even at 86 you're already happy to invest because of that upside potential. So that means that you could scale in at that level. Next week, if it goes down, that's really no issue for you. You can even buy more if you want to, as your upside potential increases as the price drops. But and on the opposite side, if the price increases next week and you haven't bought yet, then at 90, 95, you're still looking at a really nice potential return. This is why this model is quite important or quite helpful, because you can just basically say, well, now the price, since my last analysis, now the price has gone up to 95. We're still looking at a 80% upside potential, which might as well be still aligned with your investment strategy. So you would be happy to even buy at 95. I think there was a whole lot of information for you. I hope that all makes sense somehow. So I just wanted to see that this was obviously not a very detailed and lengthy explanation. It was more like, what are my key steps, and what I look at when I invest or start thinking about starting a new position in my portfolio. So this is really what I would do. I would look at the company profile, management, listen to conference calls, read the 10K or 10Q, which are the annual and quarterly reports. So really read this and understand the numbers and the risks. Do my own little high-level DCF model just to understand what price level will give me which estimated return, and then really just start a position and then really piling in step by step, not maybe all at once, because it always could go a little bit lower the next week, and then you might be better off buying it at 80, for instance. But yeah, this is what I would do, and hopefully that was helpful. Let me know in the comments below if this type of video is helpful and if you want a more detailed analysis on Teladoc. But yeah, I'll see you in the next video. Bye.